Good evening, folks, and welcome to our next edition of the Weekly Wrap. And today evening, we have with us our Senior Advisor Dhruthi Narendra. Welcome, Dhruthi.
Okay. Good evening, folks.
Whenever you pick up a bottle of medication, you will see on the side date of manufacture and then date of expiry, right? Very clear. But do you know your date of expiry? We know our date of manufacture. I know when I was born. I surely do not know when I'm going to die. And in spite of this uncertainty, many of us have neglected to write our wills. That is the minimum that each of us can do to ensure that our loved ones remain happy and we do not leave chaos behind when we go in terms of who gets what. So I would urge everybody to quickly write out a will. It's a very simple matter, and if you don't know how, reach across to your advisor and they will guide you how to do, advisor or lawyer, right? But I think there is something which is a little different, a different approach to distribution of your estate to your loved ones in the latest ET Wealth. Dhruthi, would you like to tell us about this new idea?
So I think something that we can, just something for us to think about is if we want to distribute our wealth while we're alive or, after your demise. So obviously there are pros and cons to both, and some of the positives to actually doing it while we're alive is that the whole process of succession is a lot smoother. And there are minimal disputes after your death, and the assets also go to the intended heir. But of course, having said that, there are a lot of downsides to this. One is that you actually have to be ready to let go of the ownership and the control of all of these assets. And another big thing to keep in mind is the risk to your financial security.
Right, that's important. So if you end up giving away all the assets during a lifetime and we end up living longer, then what? How do we take care of ourselves? So I guess there has to be a good balance between the two.
Right.
If you want to follow this route of distributing your assets during your lifetime, there's another positive to what you said is that you would be able to see the joy on the faces of the people who receive it, right? When you gift it to them, obviously they're going to be happy, and if I'm not going to see the joy on their faces when I'm dead and gone, so that is something maybe you would like to experience as long as this balance is maintained. So the distribution will be in the form of a gift, right?
That's right.
And if it's property, then the gift should be registered to ensure that the validity and the legality of it will not be disputed at any point of time.
That's right.
Is it not? Okay.
And of course, the other way to do it is after your death through a will. And so, in this case, you actually have control of all of your properties and assets till your death, and you're not, dependent on the heir.
Right.
But again, it has to be through a will. I can't stress enough on that, because otherwise, obviously, it leads to family conflicts and legal disputes, and the whole process of transfer also takes a lot longer.
The other point I think that has been mentioned here is that if you're gifting in your lifetime, you may end up coming under pressure from those who feel they should receive more.
Right.
So that is something one should be prepared to take. So transparency has its upsides and it has its downsides. Be mindful of both. But I guess maybe a balanced, a nuanced way is what one should be looking at this. Okay.
So another interesting thing I have in the ET Wealth is a trend map that actually talks about the performance of different factors. So the last 10 years, we've seen alpha actually give us the highest compounded return with 18.8% per annum, followed by momentum. Something that I'd like to actually talk about over here is the difference between alpha and momentum. Of course, we know that both of them are actually chasing after the same factor, that is price, and going after the same goal as well. But something that's really important to note is that their methodologies are very different, and which means that how they allocate the weightages to the different factors, the different stocks in these factors are very different. So if you actually look at the last 10 years, Alpha has had an average allocation of about 42% to mid-cap, and Momentum has had 24% allocation to mid-cap on an average. So you can see that the drawdowns in case of Alpha are actually much sharper. And Momentum is giving you much better protection on the downside as well.
Okay. So given that we've had a wonderful mid-cap rally, that could have been responsible for the outsized returns from Alpha.
That's right, yeah.
But the map also has some very interesting stories, right? And one can see that while Alpha has been there at the top of the chart for 4 or 5 years in the last 10 years, it has also been there at the bottom of the chart. So if you have to take both if you want Alpha, the tops and the bottoms, whereas Momentum has never been at the bottom, right?
Right, not even once.
Not even once in the last 10 years. So that is something to talk about. And it's there mostly at the number 2 or sometimes at the number 3 level. So it gives you a better risk-adjusted return, I would say, is it not?
That's right. So we are seeing higher Sharpe as well as lower standard deviation in case of Momentum.
Yeah. And while on trend maps, I just recall that in the last week we were discussing different countries, right? And one thing we get to take away when we're looking at these trend maps of different assets or countries or factors, whenever something has hit a bottom, what comes next is a top.
Right.
Okay. So I do see that, I did see that in last week's trend map, India was there at the bottom for the last year amongst all the other countries. So I'm guessing that next is?
Yeah, hopefully India.
Right.
So, I mean, since you're talking about actually where India stands and how we've been doing, Morgan Stanley actually had something really interesting to say. So they're saying that the correction in the Indian stock market is actually over, and the key factors that were actually weighing in on the, weighing us down, which were actually contributing to the underperformance of India in comparison with other emerging markets, are actually reviving. So they're saying that there's actually a good probability of us having a bull run. The chances right now are about 30%, but it's likely that by June 2026, Sensex can hit 1 lakh.
Wow, that would be a dhamaka, Diwali dhamaka, or whatever. So it's a human bias that we love to look at round numbers. So 1 lakh seems like a big number. Well, we are in our mid 80s as far as the Sensex is concerned. So that's anywhere like a 15 to 20% upside whenever it happens, which is similar to the earnings growth that one can expect. But while you look at a positive view from Morgan Stanley, I think one should also look at the other side of the coin. So there was an edit in the Business Standard by Akash Prakash, and somebody I follow and respect his views. He seems to have gone around meeting a number of FPIs, and the kind of response he got from them was very disappointing. So for the first time, he says they were actually questioning the India growth story. And they were asking, is this 6.5% kind of GDP growth sustainable? And the doubts really come in because of the kind of negative spotlight that India has been put into post the tariffs. But what Akash Prakash says is there's actually a backstory to it, not just the tariffs. It was after the last general election that India ended up having a coalition government. While the BJP remains the strongest amongst the partners, the expectation was that the government may tend to greater populism. And populism is bad for a country's finances, which is why they probably started pulling away at that point of time onwards. The story started there. But the fact of the matter is that the government has not gone towards populism, which is very good. And that is why our country's macros are in a good position. The fiscal deficit, the current account deficit, the inflation, all of it remained, and the forex reserves all remain very healthy. The other points that the FPI has pointed out to is India has no presence in AI or EV or semiconductors, which are the hot areas globally, which are the growth areas of the world. And they are worried that India does not have presence here. The other point that they pointed out is why Indian entrepreneurs or business people are so obsessed with short-term ROI. If you're running a business for the long term, one should not be mindful of the short-term ROI and gun for the long-term growth. But I think Indian investors are a little more immature in this, and if they're able to get past this, they would possibly consider spending more on R&D, more on innovation, which have longer runways. They need a longer gestation period, and the mind should go away from short-term ROIs and invest for the future. That is how China has been doing it. That's how America has been doing it all these decades, and we need to pull up our socks and quickly get onto that game. I don't know if he would be able to at all, but he does end with a more positive note that given that FIIs have already pulled out so much money, we are probably at a trough. Right. And even given that Indian markets have underperformed the last 1 year as compared to its EM peers and the Asian peers, the relative higher valuation has come down. So India is not as expensive compared to the other markets around us as it was last year. So that itself should draw investors back. Right. A little good news, and I think investors would come back in. So, I mean, from the bottom, we have nowhere but to go but higher up.
Yeah.
Right. And that way, if we're looking at the Q2 results, nobody expected Q2 results to be as good as they actually turned out to be. So we have data on the 241 out of the 500 companies that have declared results. And we can see that while revenue growth has been 5.2% for these companies, the profit growth has been closer to 15%, which is good. We didn't have such a good number in Q1, and that was worrying everybody last Q4 or Q1. And what I'd like to point out is amongst this batch of companies, how BFSI companies have done. So while they contributed to 27% of the revenue as a whole, their contribution to profits was 45%, which shows how much more profitable this sector has been as compared to the non-BFSI sector. And we should keep that in mind. So I think we do have investments in the BFSI sector, right? As a sector fund.
Yes.
To some exposure. But there is another article in the Mint which says that banks are expected to have a lower profitability, largely because their net interest margins are falling. And the net interest margins are falling because while lending rates have come down, the cost of deposits have not come down. So the cost of deposits will come down with a lag, and it is only then that banks may become as profitable as they were in the previous year. So let's wait for that, and investors can expect a soft couple of quarters before banking profitability picks up again, and the stock prices are able to grow at the rate that we expect them to. But in the meanwhile, their valuations are not too high. They're pretty fair. So one need not be too worried in my view. And how have bond funds been doing?
So bond funds actually in the last month, 1 month, have returned negative. So the reason is that we've actually seen yields go up and the prices of these bonds have actually fallen.
Because I wonder why. Because the RBI has been reducing interest rates, and we would have expected yields to have also fallen. So while they fell for a short while, they went back up over the last couple of months. And there is an article here which says that banks trim gilts to power loan book as deposits lag. So what they're saying is that the deposit growth has not been as good as they expect credit growth to be. And to fund the credit growth, they've been selling away whatever excess bonds they've been holding in their SLR book. Okay, and combined with a low liquidity and sales of bonds, I think that's what drove bond yields higher. So this could be a temporary phenomenon. But I think the question to ask is, why was liquidity tight? And it turns out that we always get to know much later. We never know when it's happening. Liquidity is tight because the Reserve Bank of India was trying to defend the rupee. The rupee has been weak against the dollar, and when it has to defend the rupee, it defends our own currency, it has to supply the market with sufficient dollars. And when it is supplying the market with dollars, it's taking an equivalent amount of rupees away from the market. The dollars don't come free. We are not printing the dollars. Right? So this caused temporary tightness in the market, which would have accentuated the problem that banks were having, wanting to sell bonds, the RBI wanting to have auctions, and at the same time, low liquidity. But I guess with one more interest rate cut from the RBI expected, if you're holding a long gilt, it should eventually turn out to be profitable.
Right.
If you wait for a couple of quarters and wait for this entire story to pan out. Of course, the other hot thing has been gold. It's been hot for a long while now. So what are clients still saying, Dhruthi?
So believe it or not, people still want to buy gold. I think they're just afraid of missing out on the rally. But I think we need to be very cautious now, because at these levels, I don't know if it's good to enter.
Yes, that's true. I agree with you. I think in the last week also I was mentioning that a good amount of the buying on gold and silver is not fundamental driven, but highly speculative, and could be because of the FOMO, or fear of missing out, that many retail investors piled into gold and silver in the last legs of the rally. While that was something that I was assuming, I saw a very interesting piece of data over the last week that showed that it could very well be a FOMO-driven rally. And the reasoning for that is this gentleman has apparently analyzed the Google trends, the Google search trends for gold ETFs. And it seems that the Google search trend for gold ETFs has shot up. And if you superimpose the price of gold versus the search results, they're actually parallel. So this gives adequate reason that to believe that much of it is FOMO driven, and one should be very, very cautious. Maybe if you do believe that gold has a place, which I do think gold has a place in portfolios to a limited extent, given that we get into it in a more sensible manner than rush into it when the whole world is rushing into it. So I think maybe an SIP into gold could continue, and you could buy through the possible dips that we see during the year. And yes, our ex-chief economist of the IMF, Geeta Gopinath, is back in the news with our favorite topic, AI. So what's AI saying, Dhruthi?
So when it comes to the US markets, I think something that we should keep in mind is the Magnificent Seven, right? So that's about 38% of S&P 500's market capitalization, which also accounts for 50% of the profits or returns.
Stock returns.
Yeah. So what we're seeing right now is the cyclically adjusted price to earnings ratio of the S&P 500 for the first time since 2000 has crossed 40. So the last time this happened, in 2000, it was at 44, and it was followed by the dot-com bubble burst. So the market fell almost 50%.
So are we facing another bubble or another bust? Geeta Gopinath seems to think so. So in an article that she wrote for The Economist, she mentioned that if there is a crash now, she estimates that about $20 trillion of wealth could be wiped out. And that definitely would drag many economies into a recession. And this time around, unfortunately, if a recession does happen, the central banks of the large economies hardly have any firepower left to try and stimulate the economy back. This is because they're already stretched. The global debt to GDP is very high, and monetary policy has been very loose. So how much looser can it get? And the largest economy in the world is way stretched out on the fisc already, and that is US. We all know that. And this time around, if there are job losses compounded with the productivity that AI brings in, bringing back jobs will be rather difficult in this new AI environment that we are in. And Geeta Gopinath is rather cautious about it, that we need to be careful of the valuations. The risks in the financial markets are high and the environment are high. So compounded, red flag up. Okay, and that is what she says. And some kind of a coincidence, I guess. The last time somebody in the IMF called out a bubble was our earlier governor, Raghuram Rajan.
Oh, okay.
And he was in the IMF at that time. and he called out the global financial crisis too. So I wonder, I don't want to scare anybody, but I wonder if this is something. And in this article by Debashish Basu in Business Standard, he of course speaks about the overvaluation, and he's also very worried about the kind of circularity of funds, how each company is investing into one another and is probably building it all up for a crash. How Microsoft has invested about $13 billion in OpenAI, which in turn uses Microsoft's cloud infrastructure, and thus Microsoft is simultaneously an investor, infrastructure provider, platform host, and commercial partner, and potentially a competitor. And of course, the biggest of all of them is with NVIDIA and OpenAI. So NVIDIA, the dominant AI hardware supplier, will invest up to $100 million in OpenAI, $100 billion in OpenAI, which will buy in turn NVIDIA systems. So NVIDIA has also invested in Elon Musk's AI startup xAI and will supply processors to the xAI's data centers. So this kind of incestuous relationships, which as Debashish chooses to call them, should ring a lot of warning bells. And I think one has to be very careful of the entire sector. The businesses are solid. They are real businesses. It's just that the valuations seem insane at this point of time. And one has to be careful about how one invests in these companies. Okay. So, and is there anything else that is interesting in the week's news?
So we actually wanted to add a little bit of a financial planning element to this week's episode. So would you like to comment on how a freelancer would, plan his financials?
Yes. So that was one of the articles in the Mint about freelancers. And freelancers, artists present a very different case for financial planning. Normally, one would assume there's a regular income, but with freelancers, income is not regular. There could be large periods of drought where there's no income, and they should be living on their savings. So the first priority for a freelancer or an artist is to build up an emergency corpus, and anywhere between 6 to 12 months of expenses should be in either in the bank or in the easily accessible fund, like a liquid fund, which bears no risk. And so that if there are periods where they don't get assignments or they don't get business or projects, they would be able to dip into these reserves and comfortably live. And I guess once the emergency corpus is done, the rest of the money can go into long-term investing, isn't it? So that is to be carefully borne in mind. Yeah. And every situation is different, and hence a financial planner, a qualified financial planner, should be able to detect these nuances and accordingly advise or create life plans for all of you. Okay? And that's all in this weekly wrap, folks. Do have a good weekend. Thank you.
Thank you.